Hey, welcome back to POA for you. It's Leroy again, and today we are going to go through O Levels 2021 Paper 2 Question 4. This topic is on non-current assets. Now, if you want to get a better handle on the concepts behind non-current assets, I've got a video on this. And go to my YouTube channel, search non-current assets. I talk about depreciation, capital, revenues, expenditures, and a whole host of that. But now, let's take a look at this question. Come on. So this question has a few parts, and let's take a look at the first part. They've asked us to interpret each entry on March 31st. Now, what is this table telling us? This is essentially a motor vehicle account. So any transaction that the business does that relates to motor vehicles will go through this account. And motor vehicle is an asset account, and asset account has a is debit in nature, and therefore any balances that has a debit balance indicates that you still have some assets there. So in this here on 1st of July, which is the first financial year, first day of the financial year, you have a balance brought down that's carried over from last year. And now we are saying that we have a 34,000 balance in this motor vehicle account, indicating that we have a 34,000 worth of motor vehicles in this business as of the beginning of the year. Now, there are three transactions that's booked on the 31st of March, and they have asked us to interpret what they are. Now, when you look at this transaction, let's see the first one, you have a debit entry to the motor vehicle account, and you have a description that says trade payables Naomi in the particulars. Now, anything in this particular section would indicate the name of the other account that you have that the double entry goes to. So if it's a debit motor vehicle of 15,000 here, then you are crediting trade payables to Naomi. So what does that mean with this journal entry? If you debit motor vehicles of 15,000, it means that the business has 15,000 more motor vehicles in the business. Now, and if you credit trade payables, it means that now the business has 15,000 more of trade payables. And this would indicate that the business has bought additional motor vehicles on credit. And that's how trade payables usually crystallize, right? So that's the answer for the first transaction. Capital. Now the business again now has 9,000 more worth of motor vehicles, and capital, the credit entry is gone to capital. Capital can only increase if the owner brings in something for the business. It could be cash, it could be inventory, it could be, in this case, motor vehicles. So what actually happened is Khalid actually contributed his personal motor vehicle worth 9,000 for the business to use. The last one, credit is to the motor vehicle account and therefore debit to the sale of non-current asset. Now you would see that this account only exists when you sell assets, and you are essentially moving the cost of the motor vehicles to this account, to this sale of non-current asset account. So what's actually happening here is the business sold a motor vehicle that's originally costed 20,000 for the business. Okay, so that's the first part. Now the second part is, what do you mean by capital expenditure or revenue expenditure? I've got a video on this and I introduced it to you in the introduction. And it essentially, this video would share with you this table telling you what capital expenditures, the characteristics of it, and revenue expenditures, right? But essentially capital expenditures are big purchases, and usually they last you for more than 1 year. So I would suggest that you describe that in your answer, and since it's 2 marks, give one example. And that's simple. The example is purchase of motor vehicles. Now, what's revenue expenditures? When things that you buy for the day-to-day running of the operations of the business, and it's usually low value item and it's usually used very quickly. So useful life is less than a year. And an example of this is the petrol for your motor vehicles. That's something that you use within a week and probably that's done, finished, gone. Okay? So that's the first half of the question. The second half of the question is some information that Khalid wants to buy packing machines, and it's got two options. and the question has asked you, what do you choose? Now, this is one of those questions that have come around in syllabus 7087, and I kind of applaud the syllabus for this, because it's questions that are a bit more real life scenario, and the answers are a bit not really black and white. You could choose alpha machine or omega machine in this case, and you just need to justify it, and you could get it right. Okay. So let's look at what I've done. Firstly, I've kind of put together a simple table for myself, to say that, hey, the machine price is so much, 60,000 for alpha and 52 for omega. I've assumed that each machine will last for 5 years, and therefore the annual cost of each machine is 12,000 and 10,000 plus each. Now the capacity, they told me, it could 10,000 a week and 9,000 a week. So I've just kind of used cost per unit ratio, taking the annual cost divided by the capacity, the weekly capacity, right? I can annualize this as well, the capacity, to make it like for like, but in this case I didn't, otherwise the numbers per unit would be too small, right? But I could straight away tell that alpha's cost per unit of production is higher than omega. So omega, although at the face value is 52,000, if you break it down by per unit cost, it's also cheaper, right? So I've chosen omega on a few reasons, right? The first reason is, if you look at the order lead time and the staff training, omega, once you purchase it, you can straight away upgrade your whole production facility. And maybe you are in need of this packing machine, or your old packing machine has broken down and you really need to get a new one, and this will give you immediate usage in that sense. The second one is alpha is kind of new in the market, right? A new kid on the block, untested, and you want to avoid spending a lot of money to be kind of a lab rat for alpha, right? Unless alpha comes really with strong brand equity and reliability from other machines that it has made, or other experiences that you had. But in this case, I've assumed that it doesn't, and a machine omega is a bit more reliable on the surface of things. Now, the other thing is, omega's capital cost per unit and servicing cost is also cheaper, therefore it's a lower cost for the business, and that always makes economic sense. The last one, it's a bit of assumptions that you can make, right? You could say that, hey, in the next 5 years, Khalid does not expect capacity to be more than 9,000 units, so there's no point buying a machine that can have more than 9,000 units, because that additional capacity is not really useful for Khalid's business. So that's it. Well, hopefully you found this useful. If you have any questions, please feel free to let me know, and share this. This is a free resource for everybody. Share it to your friends, and if you have any questions, you know where to find me. Okay, take care and good luck.